All right, let's talk about Keurig Dr Pepper because they just dropped some massive news at their latest investor day. And we're not talking about a small course correction here. They are literally planning to split the entire company in two. So let's dive in and break down exactly what this bold new strategy is all about. So here's the headline. KDP, as we know it, is breaking up. After years of operating as this combined coffee and soft drink giant, they're pivoting hard. The big idea here is to create two highly focused, independent companies. The bet? That these two specialized businesses will actually be worth a lot more apart than they are together.
But hang on, this isn't just a simple split. It's actually a really clever two-step move. First, they're going to acquire the global coffee powerhouse JDE Peet's. It's a huge deal. And only after that merger is complete will they spin off that newly supersized coffee business from the North American beverage operations.
So you're probably wondering, how are they going to pull this off, and what does it mean for the stock? Well, that's what we're here for. We're going to walk through the strategy, introduce you to the two new companies, look at the numbers, map out the timeline, and then finish up with our analyst take. Let's get into it. Now, the first thing you have to understand is that management is making this massive change from a position of real strength. This is not a panic move from a company that's in trouble. This is all about strategic evolution. And you know, the company's chairman, Bob Gamegort, he said it best. Back in 2018, the whole point of merging Keurig and Dr Pepper was to take two smaller players and create a single, powerful challenger in North America. And hey, it worked. It was, as he said, wildly successful. But the game has changed since then, and so the strategy has to change too.
So that begs the question, right? If the old strategy was so successful, why tear up the playbook? Well, the answer really comes down to the huge differences between their coffee and their soft drink businesses today. Just look at the difference between then and now. In 2018, you had two North American companies that both needed more scale to compete. Fast forward to today, and the beverage side of the business is an absolute powerhouse here at home. But the coffee business? Well, on a global stage, it's actually now considered subscale. It's just not big enough to win against the global giants. The two halves of the company just have completely different needs now. And this really gets to the heart of the strategy. See, in the coffee world, scale is everything. Being a global player means you have huge advantages in sourcing beans, developing new brewing tech, and spotting consumer trends. Frankly, Keurig was fighting a global war with one arm tied behind its back. Combining with JDE Peet's completely changes the battlefield. Okay, so what do these two new companies actually look like? Well, once the whole process is done, you're going to have two pure play businesses. That just means each one is 100% focused on its own game. Let's meet the two new players. On one side, you'll have the new Global Coffee Co. And this thing is going to be an absolute behemoth. We're talking $16 billion in sales, making it the #1 coffee-only company in the world. Think of this as the steady cash flow machine, focused on squeezing out savings from the merger and running efficiently. It'll own huge brands like Keurig, L'Or, and Jacobs. And on the other side, you've got Beverage Co. This is the growth engine, still massive, with over $11 billion in sales, but its entire mission is to be a nimble, aggressive challenger right here in North America. This is the company with that entrepreneurial spirit, building on the incredible momentum of Dr Pepper, Canada Dry, and its high-flying energy partnerships like C4. So the story sounds pretty compelling, right? But can the company actually pull this off? Does it have the financial strength to make it happen? Well, a quick look at their latest results gives us a pretty clear answer. And the answer is a big yes. KDP just posted an incredibly strong third quarter, with net sales growing a whopping 10.6%. This is so important. This is not a company in crisis mode. This is a business that's firing on all cylinders, choosing to reinvent itself while things are going great. And that strength, it's giving them a ton of confidence. They actually raised their full-year sales guidance from mid-single digits all the way up to high single digits. And they did that while reaffirming their profit targets. That tells you the underlying business is incredibly healthy. Okay, but there was one giant question mark that really spooked investors when this deal was first announced, and that was the mountain of debt they were taking on to buy JDE Peet's. And this is where it gets interesting, because management actually listened. They heard those concerns loud and clear. So they went out and secured $7 billion in new investments from big players like Apollo and KKR. That cash injection dramatically lowers the debt they'll have at the close. It takes their leverage, which is just a ratio of debt to earnings, from a pretty high 5.6 times down to a much more comfortable mid-4 times level. This was a huge move that de-risks the whole deal.
All right, so the strategy makes sense and the financing is now in a much better place. So, what's the actual roadmap? How and when is this all going to happen? A key number you're going to hear a lot about is $400 million. That's their target for cost synergies. It's basically the annual savings they expect to get by combining the two coffee businesses, things like shared supply chains and marketing. And finding these savings is absolutely critical because that's what's going to help pay for future growth and boost profits for the new Coffee Co. So here's the timeline. They expect to close the JDE Peet's acquisition in the first half of 2026. Then, by the end of that year, they're aiming to have all the systems in place to be ready to split. But, and this is a really important but, management made it clear the final separation is based on hitting milestones, not on hitting a specific date. They're only going to pull the trigger when they're on track with those savings, the finances are solid, and the market conditions are favorable. They want to do it right, not just fast. So, after digging through all of this, what's our final take here at Talk Tickers? What should you be watching for on their next earnings call? Look, our take is that this is a bold and, frankly, very logical move to unlock a ton of long-term value. Separating these two very different businesses just makes strategic sense. But the execution risk here is huge. This is a massively complex deal. Integrating a company the size of JDE Peet's and then trying to execute a clean split is a monumental task. For that reason, our rating is market perform. We think the stock will likely trade in line with the market for a while. The long-term upside is definitely there, but for now, investors are in show-me mode. On the next call, sure, the Q4 numbers matter, but the real focus will be on any updates about the integration plan and hitting those crucial cost-saving targets. So, will this huge bet pay off? The strategy has been brewed. Now, it all comes down to execution. This is not financial advice.